What's up everyone, it's Nathan here and welcome back. If you're thinking of purchasing a property in Australia and you're wanting to understand the current housing environment, you've come to the right place because today we're going to break down the recent trends in Australia's housing market and discuss whether it's a right time to buy a home or not. Let's dive in. First, let's take a look at the recent data. Since September of 2022, Australia's housing downturn has started to ease off. And by February of this year, we saw the drop in values almost at a standstill. Sydney led the charge with housing values seeing their first month-on-month increase since January of the previous year. This positive momentum carried over to the first half of March. CoreLogic's daily home value index showed an increase of 0.3% across the 5 largest capital cities with different growth rates in each city. Sydney's housing values increased by 0.5%. Melbourne and Perth saw 0.2% increases, whilst Brisbane's housing market remained relatively unchanged and Adelaide experienced a slight decrease of 0.2%. On a rolling 4-week basis, Sydney, Melbourne and Perth recorded an uplift in values, while Brisbane remained stable and Adelaide was the weakest performer out of the 5 capital cities. If you find value in these videos, please consider hitting that subscribe button as it really does help out the channel, and a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. This shift toward a more positive trend has been accompanied by a lower than normal number of new listings hitting the market. Capital cities listings in the past 4 weeks were 19.9% below the 5-year average. This low supply might be keeping house prices from plummeting further, even with a noticeably drop in demand. Additionally, auction clearance rates have returned to around the decade average. Another factor that could be supporting the stronger market conditions is the surge in permanent and long-term migrants. Although most of the housing demand from overseas migrants flows into the rental market, the tight vacancy rates might be pushing more people to buy homes rather than rent. It is too early to tell if we've reached the bottom of the cycle, as interest rates might continue to rise, and we have yet to see the full impact of the aggressive rate hike tightening on households, and economic conditions might also weaken in the coming months as households exhaust their savings and the labour market becomes a bit more unstable. Keep an eye on the flow of new listings hitting the market, as an increase in advertised stock could signal that the growth trend is losing steam. With the uncertainty ahead, the next few months will be crucial in determining if the housing market is experiencing a turning point or if we're just in the eye of the storm. The main domestic focus for this week was the February 2022 Labour Force Survey. The results were solid, showing a significant increase in jobs of 65,000. The participation rate also rose slightly, while the unemployment rate dropped to 3.5%. The NAB Business Survey indicated that conditions remain strong and prices are still rising at a high rate. The RBA will be keeping an eye on these 2 points of data as it approaches its April board meeting. Meanwhile, the March Westpac Melbourne Institute Consumer Sentiment Index remained steady at 78.5%, reflecting continued consumer pessimism. Australia's population growth reached 1.6% in the year to Q3 2022, which is the highest since 2017, driven by a record high net overseas migration of 106,000 for the quarter. The rapid return of the net overseas migration since mid-2022 has been confirmed by the ABS departures and arrivals data for January. The global collapse of Silicon Valley Bank and concerns around Credit Suisse dominate markets, and fears of financial contagion lead to a risk-off pivot, with bank stocks and bond yields dropping as investors adjust their expectations for interest rates. Despite this, the European Central Bank raised its key European policy rate by 50 basis points, emphasizing that it has separate tools for both addressing inflation, and potential risks to the financial system. The RBA will take these global factors into consideration for their April meeting when setting the cash rate target. While there's still some time until the meeting, the labour force data and NAB survey data alone don't suggest the Reserve Bank will pause, but the situation remains uncertain due to the recent financial stresses we've seen. We'll also see next week the release of the Reserve Bank of Australia's minutes of the March board meeting, which will hint at a pause in the rate hiking cycle. We'll also hear from the Assistant Governor, Chris Kent, who'll give a speech on the long and variable monetary policy lags, shedding light on the Reserve Bank's perspective on recent financial market developments. Internationally, the focus will be on other central banks' decision on interest rates, whilst inflationary data from UK, Canada, and Japan will be released. On top of this, the fixed rate cliff has emerged as a significant potential risk to the housing market values and overall stability in 2023. In July and August of 2021, fixed rate interest rates hit record lows and fixed term home lending soared to a record 46% of new mortgage commitments. The Reserve Bank of Australia has noted approximately 23% of all outstanding mortgage debt will be repriced at significantly higher rates in 2023 when their fixed term expires, resulting in the cliff. Now, there are some things to consider about the looming expiries. Increased financial strain is expected from April of this year as more fixed rates shift to variable loans, and borrowers may face challenges in servicing their debt, especially with interest rates rising beyond the minimum serviceability buffers of 3 percentage points that the Australian Prudential Regulator enforced at time of these borrowers getting their loans. The next is if variable rate holders can cope with rising mortgage costs, it's possible that fixed rate borrowers will fare similarly. However, the Reserve Bank of Australia notes that there are a small group of households on variable rates without savings and without prepayment buffers, which also means that this could extend to some fixed rate borrowers that have similar issues when they come off. On top of that, while increased variable rates may create short-term difficulty for households, the steep rise in interest rate repayments will not persist for the entire loan duration, and banks will also be more incentivized to lower their mortgage rate offerings to stay competitive as external refinancing hits record highs. Also, equity remains high in most markets, meaning relatively few borrowers may fail to pay off their mortgages with the sale of their home. The Reserve Bank estimates that if home values were to fall by an additional 10%, the rate of homes in negative equity would only rise to around 1%. Now, it may take a while for signs of distress to appear in the housing market. Institutions will likely work proactively to prevent mass loan defaults, possibly by implementing temporary measures or offering borrowers the option to extend their loan terms or temporarily switch to an interest-only arrangement. Australians with fixed-rate loans coming off in 2023 will undoubtedly face challenges whilst they adjust to the new variable rates. So that's it for today, guys. If you found this video helpful, please give us a thumbs up and subscribe for more property insights, and drop any thoughts you have in the comments below. And did you know, here at Hunter Galloway, we're mortgage brokers that deal with people Australia-wide. So if you're looking for a great mortgage broker, hit us up at huntergalloway.com.au and fill in the contact form where we love to have a chat, or contact us on 1300 088 065, and we'll see you next time.